Hello, everybody. Adam Parks here with our first LinkedIn Live. Looks like we are just connecting into the LinkedIn platform. We are going to be talking through the chat system here as well, although it's not popping up for me as the event has started. See if there's anything else that we need to do. Well, you know what? I think as we get this started, and as I look at the technical aspect of this, does not seem like we are live quite yet. If anybody can hear us, let's get a comment in the thread. Right. Well, that wasn't as easy as it looked. I'm like doing it on the fly, right?
That's part of the fun.
Have we ever done it any other way?
Yeah.
No, we have not, but it
Mhm.
does look like it's live recording, and it is telling me that we are connected to the receivables info page. So yeah, we are up and live. I think we're good to go, gentlemen. So thank you everybody for joining us today. Thank you, Sam, for letting me know you can hear us. We're going to be watching the chat here as we go. Happy to field some questions, but thank you everybody for joining us today. Today I've got a really great panel. I don't know that I could have put together a better panel on such short notice, especially with all of the changes that are happening at the CFPB right now. So for anyone who has not been lucky enough to meet these gentlemen, I'm going to start just in the order on my screen here and let everybody do a quick introduction of themselves so that the audience can understand what our perspectives are going into this discussion, because I think each one of us represents a very different perspective. So Manny, starting with you, could you give everyone a quick bio of yourself?
Yeah, thanks. Thanks for having me. I'm excited to speak about this topic. If you don't know me, real brief bio is I started life at American Express in a global capacity working in Latin America. And since I've been in the third-party space, helming collection agencies in first-party roles at places like eBay and Goldman Sachs. And lastly, I'm here at TransUnion, where I'm making an impact on the products and services that we provide to our industry today. I'm really excited to be here, and thank you for the opportunity to speak on this important topic today.
Excellent. Well, part of the reason that I really wanted to have Manny here is Manny's been operating on a global perspective for such a long time that he's been dealing with regulations and regulatory bodies on a global perspective. So I thought it would be good for him to be able to provide us with some additional insights as to how maybe some of these things are happening across the world. John Tonetti, how about you? Could you give everyone a quick bio about yourself? You can start all the way at the beginning if you want.
What?
I said you could start all the way at the beginning if you want.
No, I don't really want to do that. We only have an hour, right? Enough about you. Let me talk about me. Thank you for having me. I appreciate it. And I'm glad to be joining these two other esteemed gentlemen who I know from my years in the industry. I retired a couple of years ago from the CFPB, where I worked for about 20% of my career as a regulator, both in the markets area as well as in the Office of Supervision. Interspersed in between that, I think I did pretty much everything in the industry other than be a collection attorney. I worked for American Express, Manny, City and Household, as well as JP Morgan Chase. I had a collection agency. I worked for a debt buyer. I did brokerage. I've done consulting. In other words, I had a hard time holding a job for most of my career, but I'm very interested in this topic and I'd love to provide some perspective.
Well, I really do appreciate you coming on, John. And it was a pleasure. For those of you that don't know, I actually got the privilege of working for John a number of years ago when he was in the debt buying and brokerage space. So I got to spend a little bit of time getting to know John and kind of his approach to this. And beyond his experience at the CFPB, I think his general industry experience, both as a banker and on the collection side, is going to provide us with some interesting insights today. And Mark, how about you? You want to give everyone a quick update for anyone who doesn't use LinkedIn or go to conferences?
Yeah. Mark Naiman, how are you? Founder of one of the co-founders of Absolute Resolutions Corporation, premier debt purchasing company within the debt purchasing space. And for those without LinkedIn, I am now currently the producer and host of two industry trade shows, both the Collection Recovery Solutions Conference coming up here in May, as well as the Debt Connection Symposium Conference, which is in October. I typically spend my days on the phone with creditors, credit unions, financial institutions, and everyone else within the collections and receivables management ecosystem, and talking about the big challenges that we're all faced with. And so having to provide compelling, I tell this to people all the time, providing compelling content about how to account for Regulation F is a heck of a lot more fun than reconciling 427,000 Reg F balances, as I'm sure you can understand. So with that being said, Adam, thanks as always. You know that, I think a lot of these conversations spurn from us jumping on a phone and having these conversations about the industry. And as I think you know, and a big way I create my content is, these conversations are always a lot more exciting sometimes than a PowerPoint presentation, because it's just kind of an exchange of thoughts and ideas. And I love being on here with these esteemed gentlemen. And I know this is going to be a great session.
I'm excited for this one. So I thought we'd start by kind of just talking about let's call it the history of the CFPB, and give it a quick overview here. Is that this was created in 2008, got its first director in 2012, and I feel like it's been a political circus ever since. For the most part, it seems to be highly politicized. No matter who's in the White House, that seems to be this kind of back and forth push. And I know through the years we've talked about the political pendulum and how the political pendulum swings back and forth with each election or each change in administration. And I think this time we're seeing, a much more aggressive approach to the CFPB and kind of reining them in. From an industry perspective, though, I think it's been interesting to see really how the CFPB has been viewed through the years. Early on, I don't think there's anybody on this panel who would say that the CFPB never should have existed, or that they haven't done some positive work for the American consumer. I know personally my concern with the organization through the years has been directly related to the overreach and the, I'm going to call it, liberal interpretation of their objective. Kind of reaching a little bit further maybe than they should have reached or had the authority to reach in the rulemaking processes, or lack of interaction with industry to actually talk about the realities of how these things have come to be. So I thought maybe we'd start this conversation by talking a little bit about our own experiences kind of with the CFPB through the years, and just kind of talk about, let's take a few minutes to talk about how we got to the point that we're at today. We don't have to go through, the logistics of it, but from your perspectives, what have your experiences been being regulated by the CFPB or working for the CFPB?
You calling someone out, or someone jumping?
No, I'm going to
it?
throw this out for random discussion at this point and just kind of see how it goes.
I'll take a stab real quick, okay? And as usual, Manny has a big mouth. First off, it's a great question. And I like to start by saying and applauding the great men and women at the CFPB for everything that they've done today, regardless of where we sit on those decisions. Those people worked hard to regulate a business that, quite frankly, we all would agree required regulation. It just did. And I think they've made us a more empathetic and better business for it. And the people there, between layoffs and uncertainty, are going through some stuff. And I would encourage all of our networks and anybody who can to reach out to these folks, try to hire these folks who are now looking for work. These are, experts in their field, and I really feel for what they're going through. I'll tell you, when the CFPB first, was coming on, as we said it, I was at United Recovery Systems, and we were all anticipating the worst, trying to, when they went through just trying to interpret the FDCPA for us, we were all on pins and needles on how we were going to comply and what enforcement looked like and all of that. And it was scary. It was scary. And I remember the audits, and then, at Convergent being a reporting agency, and, having the mini audits every week and all of that. And it was a tedious affair and hard work that the CFPB took on, and that we had to take on in order to comply with much more defined requirements that existed before the CFPB interpreted those. And I liked the work. I liked the work of interpreting the CFPB and creating a more practical guide to doing so. I think, to your point, politics has played a big role in where the CFPB overreached and didn't overreach, and it's become a political nightmare. And I'm afraid, aggressive, I don't think is the right word for the whirlwind that we've experienced just in the last few weeks at the CFPB. But I'm sure we'll speak more about that later. But it was tedious. It was rough and tedious, but it wasn't something that, we didn't look for. If you remember the days of 400% penetration, find a dummy a day on the phone and those type of strategies that were going on, I applaud what the CFPB did and how we took on that type of approach.
So, John, from your perspective as someone who's been on the inside, how do you feel the experience of the early days of the CFPB and its evolution kind of played into this?
Well, I'm going to start off by saying that I am an unapologetic supporter of the CFPB. I went to work for them on two separate occasions. I left for a little while and went to work for a major credit bank. And I know for a fact that the people that work at the CFPB are diligent, they're hardworking, they are extremely bright. I didn't always agree with everything that everyone did, but generally speaking, I never had any issues kind of separating our interpretations of what we thought should be done from, personal relationships and things of that sort. I always have felt that one of the major problems with the structure of the Bureau was it's designed to be unaccountable to Congress and therefore to the electorate. And that raised a lot of the pendulum swinging that Manny kind of talked about, where, you have one administration that says do this, and then you have the next administration that says do this. I think that part of the issue that you're seeing today arises from the fact that for the last 2 or 3 years, the Bureau has gone out of its way to obligate the industry to its, quote, novel interpretations of the law, unquote. And I'm not just talking about in terms of enforcement actions or in terms of supervisory examinations, but I'm also talking in terms of trying to set prices in the market and developing reports that were, in my mind at least, slanted to one side of the equation as opposed to presenting a balanced approach. And I think that to a certain degree, had they done that, the consternation and the upheaval that is happening right now would not be as great.
I agree with that. I think had Chopra not been the director or behaved in the fashion in which he did, I don't think the CFPB would be under the same kind of fire that it is.
Right.
I'm sorry, Mark, you and I often disagree on this. So I'm curious for your perspective.
I'll tell you what the last month has really kind of resonated, or the thing that's got me thinking about the most, and the difference between the prior kind of changes. And when I say prior, a little bit of my history, I of course was around and part of several committees on the RMAI. Back then it was the Debt Buyers Association, where if we're going back to 2008 and 9. Mm-hmm. And so at that time we were kind of starting to develop the certification program because we knew that we needed to become as close to an SRO as possible, right? We needed to establish these baselines, and we spent all this time and effort and money in creating a policy and kind of baseline procedures for people within the space. And all of these guidelines either met or in most cases, like 70% of the cases, exceeded those standards. And so, here I am, part of an association that's really trying to create this kind of uniform approach to an industry that we live in, an industry of exceptions, right? The laws on a state level are changing on a daily basis, on a federal level. And so here comes the CFPB, and we understood that there was going to be this, call it this kind of evening process. And in my experience, the one thing that I remember the most was the complaint portal. And the complaint portal is all of this data kind of coming into one place. And from my perspective, I remember meeting with a couple of industry leaders at that time, and you could do a freedom of information request to get some of that data out of the system. And in running those analysis, we found that there were some very interesting things, right? As a new product, as something that was brand new, we needed to understand how to work within that. And then we're talking 2013, 14, 15 comes along, and all of a sudden, I've got a picture here somewhere of here comes Mick Mulvaney. We've got a change in the administration, and the entire organization goes from the CFPB to the BCFP, right? And that was like the big change that took place. But I'll tell you the only difference, quite honestly, that I sense right now is the way in which the media provides us this news, this information, these things that are taking place, right? 12 or 13 years ago, people were not as enamored with social media, with X, with Twitter, with all of these other methodologies of getting news. And I don't believe that there was a frenzy of media that was covering this like there was 12 years ago. I would suggest we've kind of seen this movie before in some ways, right? As Adam suggested very early on, there's this pendulum, and I agree with everything that Manny and John said. They've done a tremendous amount of good. The one thing that terrifies me the most is just the uncertainty. The amount of time that we spent either in Washington trying to explain things like meaningful involvement or these types of complex theories. Fast forward to here we are, even with Rohit doing a lot of enforcement through or rulemaking through enforcement. I'm only hoping that we can find this clarity that people are seeking, right? This industry is willing to be a participant in discussions. The challenge becomes that nebulous gray area of uncertainty.
It's about being able to actually be heard and have a conversation that goes back and forth, right? And to actually be heard in that conversation. And, I think there's sometimes if we look at Reg F, like the industry didn't delay, right, actually resolving some of those issues. And as you mentioned earlier, millions and millions of records being reevaluated, and a lot of work went into meeting that standard. The industry did not delay for even 1 minute. We created education around it. We created standards around it, right? The industry took on that self-regulation and started moving forward very, very quickly. And I think you're right. The clarity is the key factor that I think everybody is ultimately looking for. Like, what are the rules of the road so that we can stay on the road? But if I can't see the lines and I don't know where the road is, it's awfully hard to stay on it, especially when the road changes based on the whims of an individual. And I think that's been my biggest problem with the CFPB, is that it's driven by an individual, and not just an individual, but a political appointee. And maybe that's not the appropriate structure. I don't know. It doesn't sound like they're going to change the structure anytime soon.
That's going to take an act of Congress, and you know how difficult an act of Congress is.
And like I said, I don't expect they're going to change it anytime soon.
I think, though, that you made a really good point there when you bring up Regulation F. I was involved with Regulation F throughout its lifespan, the development of it, the ANPR, the notice and comment. In fact, I left for 3 years in between. And when I came back, I thought, like, wow, I'm still working on this. Like, you didn't finish this? I was hoping to get out of this. But it does speak to the degree of consideration that the Bureau gave to that rule when it first developed it. I mean, Reg F is basically an attempt to interpret thousands of individual court cases and provide some kind of rules that make sense to the industry. Now, I'm not saying it's perfect. And in fact, I think to a degree, you can tell how good a rule it is that nobody was really happy. Like, no side got everything they wanted. And it was, certainly sort of splitting the baby to a certain degree. But then you contrast that with some of the rules that have come out in the last 2 years and particularly in the flurry of things post, November's election, where there was like a 3-month notice and comment period, and the rule was, or maybe 60 days. And then the rule came out 30 days after that no one in their right mind could say they gave these comments the same kind of consideration. It's like, okay, you're going to take your comments, we're going to wait a little bit, and then we're going to do whatever we want anyways. And I think that's part of the reaction. I don't necessarily think that is reflective of the staff as much as it is from the top. And to your point, Adam, the degree of political influence. We have to do something. We're going to force it in. And even worse, at least those are, you could say, well, they went to the APA and did it correctly. The worst ones are the blogs, the interpretive rules, the
regulatory
advisory
highlights,
opinions, supervisory highlights. I could talk
they
about.
treated it like the rule of law.
Well, I agree with you there. And I think that's been an evolution, because in the past, the supervisory highlights was a really good information source where the Bureau would say, this is what we found in one or more entities, and this is how we feel about it. And so the industry could take that back. And I think that, ACA and RMAI did a really good job of saying, okay, and putting it in their conferences and their webinars, this is how we think the industry should deal with it. Now, not every industry or not every entity did that, of course, but at least it was consistent. Then it became that this is what we're going to look at. And in essence, it became, to, I think it was Mark's point, regulation by supervisory highlights. And that's a totally different matter to me because there is no interpretation. There is no back and forth. And to be very honest, the degree to which they described the incident that they found was really sparse. So it was hard to say, am I doing this or is this something entirely different?
That's the gray area, right? The lack of clarity. And I think that's what the industry has ultimately been looking for this whole time is clarity.
After spending 7 years lobbying Washington on behalf of the industry, winding the clock back a little bit, I remember one very specific thing. And again, just to underline the fact that, the people that are members of these associations, the people that are on this webinar, the people that are staying involved and staying engaged are all trying to do the right thing. But I remember when the OCC popped out with an advisement bulletin that basically said that any sellers of accounts needed to limit the amount of litigation. This is 2011, 2012. The CFPB comes out. So it's 13. And so the CFPB comes out. And in the meantime, you have every bank out there that's interpreting this rule in their own separate way. Some are segmenting accounts. Some are saying you can't litigate on anything more than 20% of the balances. Some are addressing it by splitting files in this very strange way. And then all of a sudden you've got the CFPB, which kind of says the limitations aren't quite as specific as the OCC, and we're back in that gray area. But at the end of the day, the simple fact of the matter is that most people in the space weren't just willy-nilly suing every account. There was always a limitation. There was always controls in place to ensure that litigation is being used as a last-ditch effort, not as a right-out-of-the-gate thing. Were there examples of it in the space? Absolutely. But that overarching advisement led to a period of confusion. And that's what terrifies me most about what we're going through now. I think everyone in this industry is trying to do the right thing, but we've lacked real specific clarity, and there's always this kind of open to interpretation, especially in these times of turmoil.
I'll add, while we're all looking, and we're probably going to get into where we're going or where the CFPB is today and where we anticipate it going somewhere in this conversation. I think especially, that pendulum swing that you described has not only left everybody trying to respond differently, but it's also left different trails and breadcrumbs as they've exited. I think our last director of the CFPB did an amazing job of working at the state level to establish breadcrumbs that we'll have to deal with should, say, CFPB goes away, which I agree. It's a congressional act. I don't think it's going away, and we could get into that later. But should that regulation of that one body not be as significant as it has been, and now we got to deal with states having to deal with their own legislation and not having the CFPB to rely on as heavily, that's going to be much more complex, as we're seeing in places like New York. Don't get me on my soapbox about their recent social media decision, or other states will start doing their own thing, and we'll now be faced with, instead of having to comply with the CFPB's, I'll call oversight, which was complex enough for us. And I applaud our industry. If you think about all of the technology that arose just because of having to respond to regulation, quite frankly, the customer experience that we created, in a huge part because we shifted our thinking in order to comply with regulation. And I think that was the overall benefit of working through and having bodies that got that detailed into our business. It really gave us a different lens on how to approach the consumer, the customer, the debtor, and that definition started changing as we worked with the CFPB. And I actually appreciate that view.
Go ahead.
Yeah, I was just going to say, we spoke specifically about Reg F, and I'll take the 7 and 7 rule. I know I'm not going to be popular for saying this, but I remember working for folks, and I won't mention any names, that, we have to think about 4 or 5 times a day, even in the first party space. And I'm sorry, that was just intrusive and, unresponsible in some cases. And I think the 7 and 7 rule, as limiting as it may seem to certain agencies and companies and strategies, is, needed regulation that put us in a situation where we started leaning on digital communication channels more, self-service options more. Because it created different strategic views because we were now limited to what we can do. And it really helped operators convince their leaders, owners, corporate structures, hey, we can't do this anymore. We need to do this. And we're seeing the benefit of it now. There's plenty of our peers that are selling products, created products, and are helping not only people make money, but, consumers overall because of this regulation. Off the soapbox.
I just wanted to say something that, if you wanted to say nothing else that is positive about the Bureau, I think the attitude of the industry changed because of the Bureau. Back in the day, if you asked someone, how do you know if you were compliant? They would say, well, we don't get any complaints.
Not getting sued, yeah.
Yeah, and we're not getting sued. And you go, well, that doesn't necessarily mean you're compliant. Nowadays, if you ask someone in the industry, how do you know you're compliant? They point to a manual. These are our policies. These are our procedures. This is our test and control. This is how we prevent and detect errors. There's a litany of things that didn't exist.
Certifications, all kinds of stuff, yeah.
Yeah. I mean, the RMAI certification, that didn't exist before the Bureau. And I vividly remember sitting in a meeting in Delaware, and I'm trying to think of who they were. I think it was one of the agency groups, and I can't remember, and probably shouldn't cite them anyway. And they were making a case to start a self-regulating organization for debt collectors. And I will never forget that someone finally stood up and said, it wasn't me, I was working for the Bureau, I just started, but it was someone in the industry who stood up and said, you know something, guys, that ship has sailed. We should have done this years ago, and we haven't, and now we're going to pay the price. Now, should it have been done? Of course it should have been done. I mean, the culture needed to change in the industry. And I'm not just talking about debt buyers, I'm not talking about collectors, I'm talking about the credit
Financial
industry.
services.
Right, exactly. Because there was kind of this point of view that, to Manny's point, let's see if we can get 400% or 500% penetration on the list today. And I'll never forget working at a bank, and they were talking about calling and calling and calling. And I said, excuse me, guys, how many times do we have to leave a message before we realize Adam is not going to call us back? Like, why are we even spending our time doing this? And yet we persisted. And part of that, of course, was we had clients that said, you need to go through this list 3 or 4 times a day. And you'd say, I'm not getting anywhere with it. I want to close and return. No, you can't. You got to keep it. And so you just spun it on the dialer. So I think that the Bureau has been instrumental in changing the viewpoint. Now, I also think that were the Bureau to go away or be, quote, defanged, you might see some of that going away too, because I see it in LinkedIn posts where people go, oh, thank God the CFPB is going away. I don't think that's good for the industry.
I think it's actually a significant challenge for the space without the federal regulator in place, because you're going to end up with, call it 12 states that are going to create a mismatch that's almost impossible to comply with. And I was listening to one of the New York calls with a lawyer friend of mine who's unrelated to the industry, but sat there, listened to the call, and then looked at me about halfway through and went, they're literally contradicting themselves. Like, this would be impossible to comply with.
Yes.
And I think I was texting with you during the call. And I said, look, I don't know what to tell you, but this is what our future looks like in the absence of a federal regulator, is going to be this mishmash of states that some will listen and some will learn. And I know, David Reed from RMAI and the ACA team and all that are out there actively working on a state level to help educate these legislators, but there's plenty of legislative bodies that don't care. And it's
Newton's third law.
It's about the headlines.
It's for every action, there is an equal and opposite reaction.
Yeah.
With the inadvertent, call it temporary pause at the CFPB, you're already starting to see the state attorney generals move towards more comprehensive pro-consumer litigation. Personally, I'd rather deal with one front than all of the fronts, 12, 13, whatever the case may be.
And if the CFPB comes back into play, I'd like to see them focus a little bit toward like that origination of it. And I'll give you a perfect example. I was talking to one of our really good friends in the auto space, and he was talking about how repossession and remarketing is under fire right now from a regulatory perspective, and how they're only talking about it from that perspective, not talking about the car dealerships that were charging 10, 20, 30,000 over MSRP, or the irresponsible lenders that lent more money than they had metal on the street. And I honestly am not quite sure why we haven't seen some sort of a Federal Reserve call to this point for some of those lending institutions, because if they're deposit institutions, they don't have enough collateral to support the loans any longer.
But they're not defaulting.
Yeah.
I mean, no, but the delinquency is rising like a balloon.
Yeah, we've seen that.
So as we kind of hit about
TransUnion report, though.
That is in the TransUnion industry report, tu.receivablesInfo.com, not to, drop that too hard here. But hey, look, we're about halfway through this, so I want to start moving into kind of some of these predictions. So I thought we'd kick that off by just running through the first 11 days of this month. What is it, the 19th today? So, up till about 8 days ago. On February 1st, President Trump dismisses Rohit Chopra and appoints Russell Vought as acting director. Then on the 3rd, so 2 days later, we've got the Treasury Secretary Scott Bessent, who's designated as the acting director to leading to internal confusion. And then on the 11th, we have the top CFPB officials, including assistant directors, resigning in response to the operational halts. And I believe it's been about 40% of the staff that's been laid off to this point, which to those that are in the debt collection industry, like what a prime opportunity to hire highly intellectual people that may have some insights into how your business is viewed by the government. But that's another story for another day. Now, in that transition, guys, there's been more to it. That's what happens from a presidential front. But then you've got on January 29th, Ted Cruz dropping a bill to basically move them to independent funding. We've seen a stop of the funding coming from the Treasury. But from my understanding, it sounds like their coffers are not empty. So it's not like stopping the new money coming in from Federal Reserve is should have any operational impact on the organization. So maybe you don't need to grow the coffers too much. And if this current administration and this current leadership does one thing, I hope that they start really distributing all of the money that they've been holding to help the consumers that they've been holding in these fines. And we start seeing, I know it started over the last year, which go for Chopra. That's probably the one positive thing that I can really point to. I'd like to see more of that.
Adam, you really got to start, stop holding back and start telling us how you feel.
What can I say? I was raised by a World War II vet. I have a strong point of view.
Let me shift gears and just ask you a question. I think that, this is an interesting one, at least from a practicality standpoint, having attended the conference last week. As of, kind of the end of the year, it was no more medical credit bureau reporting. And then here we are now 2.5 weeks later, and it's like, oh, we're just kidding, right? You can still report that. But a lot of people aren't doing it, right? So let me ask you this, and this is kind of an all-in question, and I realize it's a little bit of a loaded question. We went through a very interestingly similar situation some years back when all of public records were removed from credit bureaus. And there were a host of reasons why that took place, inaccurate balances, et cetera, et cetera. But the big news at the time was, watch how much this is going to help consumers' credit scores. And there's a very similar kind of narrative regarding medical reporting. And I think on the surface, everything seems very simple. Like, of course it does. It's going to go up a couple hundred points because that negative stuff's not being reported. My challenge here is that the same thing when we had public records disappearing from credit bureaus, underwriting just simply adjusted their figures to account for the fact that these things had disappeared off of the bureaus. Again, are we dealing with news being quite separate from the reality of the situation? Or is there really more benefit than I'm putting out there? And I realize it's a bit of a loaded question, but it's fascinating to me because, again, most of the people that were credit bureau reporting and stopped have not just immediately restarted, which to me is indicative of, look, best case scenario, let's take the path of least resistance.
You probably don't want to get me started on this.
So let me throw
Maybe
one thing in here before John goes down the rabbit hole. Before John goes down the rabbit hole, my concern here is that creditors only have, I understand from the debt collection perspective, but from the creditor perspective, the creditors only have two levers to pull when this happens, right? If their risk is increased, they can either increase the interest rate and they can charge more for the money that they're lending, right? Or they can pull the other lever and decrease the availability of credit. But those are the two levers that they have to work with. And if we decrease the value of the information being provided to a creditor, we're actually going to end up challenging these consumers in the long run.
Can I start?
Yeah, please.
First of all, the removal of medical debt from credit reports is based upon the premise that medical collections are not predictive. That is not the case. And ACA put together a really nice paper on that. But even if you go back to the original source document on this, the 2014 report on medical debt, you can see that that's not what the report says. In fact, they couldn't do an analysis of consumers with just medical collections versus every other type of collections. They had to segment it into more medical collections than regular collections. And so, which to me, definitely, I mean, I'm not an econometrician, but that shows me that it's predictive, number one. Number two is part of the granting credit is adjudicating the willingness and ability to repay. If you're not reporting medical debt, and I would submit that most people don't have medical debts that are catastrophic, but there are people that have medical debts that are catastrophic. But if you can't evaluate that and it's not that medical debt is not collectible, it is. And in fact, you can sue over medical debt. But if I'm giving you a mortgage, not knowing that you have a $10,000 medical bill that might impair your ability to repay me, I think that's material. So I'm not a huge fan of that. And I think it was shoved down people's throats. And I also think that the bureaus kind of put themselves in this position, sorry, Manny, when they said, something, we're just going to unilaterally remove everything under $500. Like, that's not material. It is material, at least from my perspective as a former credit risk manager.
Yeah. Wow. Thanks for putting that in my lap, John. I appreciate you. Mark, I don't know if you got any text messages yet, but I'll send it shortly. So look, I'm not an economist, first off, right? So I can't speak to whether or not reporting medical debt is going to increase or provide more better credit scores and stuff like that. That's just not my world. I live in third-party collections for TransUnion. As a human, I'll tell you, I kind of agree with the concept that we don't enter into an agreement to get into medical debt, right? I think that the way medical debt arises is more important, and that's where we missed the opportunity with the credit reporting. I think it was too broad of a brush to say just medical debt itself can't be reported. There's so many different nuances in medical debt, right? Is it a leftover balance after insurance? Is it a total self-pay? Is it an indigent patient? And while we have these programs and various programs in place to help patients, especially with their financial responsibility, those aren't easy to navigate. They're not always successful, and they're challenging at the consumer level, to say the least. So I think if we're going to exclude, or if we're say exclude medical debt from credit reporting, I think, again, that's too broad of a brush, and we just needed to define what should and shouldn't be reported regarding medical debt rather than just excluding any type of debt. To John's point, not only if I'm a bank do I want to know that, there's this medical debt out there, but now by not reporting it to a credit bureau, I can get sued for it. My asset can get liened, and now I have a bigger issue because I wasn't aware of that when I made the loan to begin with. Now, I'll say the reason that credit reporting exists, I don't think anybody here would say that, we created credit reports as an engagement tool. I think they were created as a decisioning tool, right? And the industry has far long leveraged credit reporting as an engagement tool. I'm very happy to see, and I'll quote it again in the most recent TransUnion report, that the industry is actually reporting less overall, not just in the medical space, but we're using, the specific question was regarding using credit reporting as an engagement tool. And a significant, what was it, 13% drop in how agencies were using credit reporting as an engagement tool. And I think that's the trick, or what I'd like to see more in credit reporting is let's not look at it as an engagement tool or a punishment tool or something like that. Rather, as an informative tool for future creditors to make decisions based on previous behavior, which is what it's intended for. If we stick to that poor result, I think we're fine with credit reporting. But again, medical debt collection specifically, again, thanks, Mark, I think was too broad of a brush and needed to be defined accurately to a use case or a result-based case scenario as far as each reporting.
But, I agree with everything you said. And I think that just to amplify that a little bit, part of the engagement tool was, again, going back to this culture of compliance, where it was much easier for me as a collector to put a line on your credit report. And, we all know that there are some small balance collectors out there that did this and just paste the world with derogs, wait until Adam showed up to buy a car and find out, wow, there's a $300 medical debt collection on your bill. You need to take care of it before I can give you the loan. And then they would engage. And at that point in time, I think there is some truth in that people were just like, I just want to get rid of this to get this over with and done. And, Reg F put a stop to that, or I should say, attempted to put a stop in that by making a collector have to advise before they were going to put something on a credit report. So, or at least make an attempt to collect the debt. But I think that goes to something that really is a success story for the Bureau.
Fair. So as we talk about the Bureau and as we kind of go into our last 15 minutes here, I thought it would be interesting, since I've got such great minds related to the financial services and debt collection industry, to maybe speculate wildly about what may be coming next. And I don't truly mean to speculate, but none of us really know what's going to happen after the March 3rd stoppage, right? We've got a stay right now. I believe there's something happening on the 3rd, and we should have more information about the future of the Bureau at that point in time. But from a realistic standpoint, and correct me if I'm wrong, John and Mark, because I know that you guys are deep into this, but like the medical reporting rule and those things, isn't there a Congress look back period here that's going to come into play for us to get a better understanding and for the current administration to make some decisions on some of these things that came out in the last few minutes?
Well, yeah, there's a Congressional Review Act, which they can reverse. Congress can reverse rules that were
finalized in the last 90 days.
Within the last 60 days, I think, or something like that. In terms of where I think the Bureau is going, I may be optimistic. I may be naive. And I may be a little bit tainted because I still have a lot of friends that work for the Bureau that I think are really good employees and really doing necessary work for American consumers. But, I thought that the nomination of Jonathan McKernan was a positive step. This is a guy that is a regulator. And so obviously, or at least in my opinion, isn't someone you would appoint if you would want to, quote, delete, unquote, the Bureau. The other thing to keep in mind is that deleting the Bureau is not so easy. There are statutory requirements in the Dodd-Frank Act, which again is an act of Congress that you can't simply ignore. One of the rumors that I saw this week was that, and in fact, I think there was an injunction, was that the, DOJ or whatever you call it, deleted all the complaint data and all the records from the Bureau. You can't do that. That's federal offense. Those are records and are governed, I believe, by the Federal Records Act. So, you can't just get rid of all the stuff that the Bureau has done and say, well, we're not going to do this anymore because Congress has mandated that these items be done and that they be done by the CFPB. What you might see, which I think goes back more to the Kraninger administration, is where the Bureau stops doing novel interpretations of the law, stops citing people for risks of violations when no violations exist, stops saying, if this occurred and this occurred, then you would have had a violation. I mean, one of the things that blew me away as one of the last acts under the Chopra administration is they cited, I think it's Livingston, for not considering medical debt in terms of credit evaluation to give people mortgages. And then 4 days later, they issued a final rule that says medical debt can no longer appear on a credit report. And I'm like, how can you do both? You can't, if you don't have access to the information, you can't consider it. Yet here the Bureau is 4 days before they said, delete all this stuff, or that it can't be furnished anymore. And it's not furnished, so you can't report it anymore. Just to text Manny, it doesn't affect anybody else. That you have to consider this, but yet you can't get access to it unless someone tells you, oh, by the way, I got a $25,000 medical debt you might want to think about when you're evaluating my mortgage. Who does that? No.
So, John, from you talk about the complaint data, and I think that's an interesting one because that was one of my biggest challenges when we had ComplyArm and we were actually collecting complaints on behalf of the debt collection industry and managing what was happening in the complaint portal. Do you think that, let's assume that the data hasn't been deleted because that seems like a rather aggressive step. Do you think maybe they might deduplicate it at some point and like let one complaint represent one complaint? Or do you think that they continue to
have
leave
you been
the
in that
inflated
data?
numbers?
What do you said? No,
of course
way.
I've been in that data. I built dashboards on that data,
Mark.
No, but that's why I asked the question, right? Like, so if we're talking about this political pendulum swinging back and forth, I don't know why it wasn't done in a Cranager, but like, are we ever going to dedupe the database?
There are two speeds.
It's not so easy. It's not so easy. And, I went through, I worked with the database a lot. I can think of one specific project I did, which was during COVID, and it was a complaint about a specific entity. And I had to download all the complaint data for this entity around the COVID time period and put it into a CSV Excel spreadsheet. And then you start going through the complaints. You go, holy crap, this is the same complaint over and over. Sometimes it's the same consumer over and over. I know that there have been attempts to dedupe it. I don't know how robust it is because one of the things you have to consider is that the more complaints you have, the more you validate the need for a consumer financial protection bureau.
I agree.
So I think that when you look at, a couple of years ago, you saw this huge jump in credit reporting complaints, and it surpassed debt collection complaints as the largest, and not by a little bit, but by a lot. And then you start going through those complaints, you realize these are all bots filing complaints for CROs. So to answer your question, it needs to be done. How they do it, I can't answer that question.
We wrote a script and tried to hand it to them, but they weren't interested. When we were one of the first groups to ever connect into the database directly in order to push and pull information when they opened the API. We were like user number 2. And we wrote that script and handed it to them, but there was no interest in it because, to your point, the higher the volume, kind of the difference there is. But
I pointed out the number of duplicates on multiple occasions because the complaint database is used to determine who they're going to supervise or who's going to get an examination, as well as to determine whether it's an examination or an investigation. So without some data integrity, it's pretty much garbage in, garbage out, right?
But if it's used, if it's clean, right? Like if it's a clean data set, it's a great thing for the American people to be able to have that open line of communication to a government regulator. There's some positive aspects to it. If it's being deduped and used correctly, then I don't see it with the same kind of problematic way that we viewed it. Because the larger the organization, the more the complaints that they're going to see. Like that's just the inevitability of it.
Keep in mind that there are two aspects to the complaint database, one of which has been very effective and one of which has been less effective. The deduping is the less effective piece, but consumers complaining has been actually, in my opinion, good for the industry and good for the consumer. The reason that we have a problem with the data is because very early on, people realize, and some of them are industry participants, that if I complain, it's more likely that whatever I'm complaining about is going to be resolved in my favor. And so, I complain that someone's put a line on my credit report and the agency goes, it's just easier to delete it. Now, technically, that violates the FCRA, which requires an investigation. But the chances that somebody's going to say, you violate FCRA by deleting these, unless they're in there for some other reason, are relatively small. But you don't get any more complaints either. So, yeah, to your
Manny,
point.
I think we lost your audio. Technical issues. That's okay.
While Manny gets his audio going, let me answer your question, which is, what is the future, Adam? And I'm looking into the Markstradamus crystal ball, and I will say that, that like 2014, 15, 16, if you just ignore the news, I think that we're going to have less done than more. Do I see a potential change in the funding structure? Yes. Do I see the CFPB going away? Absolutely not, under any circumstances. Harkening back to the last change, back when Director Mulvaney was acting for a very short period of time, I attended a trade show, and in the general session, they started chanting, "Down with the CFPB." And it was like the, general attendance. I don't think I've ever been so embarrassed, especially because a few of my friends at the CFPB, Gandhi was sitting in the room, and I've always been part of the conversation. I think that it's important to continue to engage, to be part of that conversation. And from a crystal ball perspective, I anticipate hopefully having some traction and getting some new speakers, those that are willing to come to conferences, that are willing to kind of share what's actually happening inside. Because, like John said, John is unapologetically a supporter of the CFPB. I have to apologize a little bit because they've caused a lot of my friends in the space undue stress and pain, but I still acknowledge the good that comes out of there. And from my perspective, being part of the conversation, being able to have a conversation, I think is the most important thing, especially for an industry that is so involved. And look, we've got 3 minutes. I was going to mention Chevron deference decision.
I
was going to say, look, the Chevron deference decision and what you're seeing in the news with Trump talking about, like, I'm setting the laws. It's funny because I don't think a lot of people are corresponding or tying out this Chevron deference with his most recent comments on social media. And that's within the last 24 hours, I think. So I know we don't have a lot of time for that, but it was just kind of my last point regarding media and the difference of that in 10 years.
I mean, it looks like the news reporting will continue to change over time here as well. I think we've seen, even within the press corps and those that are able to cover it. I mean, I know that I've asked CFPB members, friends even, to to come participate in a podcast and talk to us about some of the good things that you guys are doing over there. And I've been met with crickets or just flat out denial from their media department. So I hope that they do open up a little bit and we can start having open conversations, because I think the black box is something that creates muddy waters and uncertainty. And that's really what we're trying to avoid here, is the uncertainties that come with just not knowing, because the only thing that you can fear is fear itself, and you can only fear something if you don't own it, or you can't see it, or you can fear the unknown, and that's about it. So I really want to thank everybody.
Considering a fourth term at the CFPB, maybe?
No, Mark, being a gadfly has its own rewards, If I say anything, I try to make sure that it's reasonable and, my perspective, but no, I have no desire to, I sold my time for too long. I'd like to keep it for a while.
Being a troublemaker, I apologize.
I know, I hear you.
Can we hear you, Manny? No. All right, I think we'll kind of wrap this one up here. I really do appreciate everybody joining us for our first LinkedIn Live. Our technical capabilities will continue to improve over time here, but we will be doing a repost on Friday on YouTube for those that want to share it with your colleagues, that want to participate in the discussion. For anybody that has questions, comments, concerns, you can leave those on the LinkedIn Live video. And I know all these guys, including myself, are going to be on LinkedIn, and we'll be responding to those just as quickly as we can. But thank you, everybody, for joining us today, guys. I really do appreciate your time, your insights, your knowledge. Like, I could not have asked for a better group of people to have this discussion.
Thanks for having us, Adam, as always.
Yep, absolutely.
And thank you, everybody, for watching. We'll see y'all again soon. Bye, everybody.